Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone for all of your support on the channel. All the viewers, all the subscribers, immensely appreciate the support. Today, as you can see here, we'll be talking options trading on the stock market. Options trading is a much more sophisticated way of buying and selling stocks on the stock market. You're actually not buying individual stocks or securities. You're buying contracts to buy those stocks and securities. So it's a much more complicated and complex way of trading on the stock market. Because of that, I'm going to break down these options trading into a 4-part series. For the first video here, I'm going to focus on one of the most easily understood ways of trading options, and that is the call option. You're buying a stock for a specified price in the future with expiration date on the contract, and you're hoping that the price of the stock will increase. Again, it's very complex. I'm going to try to break this down as simply as I can. In future videos, we'll go through some of the more sophisticated ways of optimizing these trades. But for this video, the purpose is simply going through and really describing what an option is. And again, going through a call option, one of the most easily understood ways of trading options on the stock market. So to begin with, let's just kind of define what a call option is. A call option is an agreement, a contract, if you will, that gives an investor the right but not the obligation to buy a stock at a specified price within a specific time period. So there's a specific length to the contract, and the contract will have on it the price that you're willing to pay for a stock. Again, you think a price of the stock is going to go up in the future, so you want to put a price on that, which you think at some point the stock will go above that price. You can go ahead and buy the stock for less than what the current price is at that point in time, and then make the difference off of that trade. You buy the stock at a lower price, and it can immediately sell it off whatever the current price is above the price on that contract. We'll kind of go through to make sure everyone understands exactly what we're talking about when we talk about specified prices and expiration dates. There's two very important things with these contracts. One options contract is for 100 shares, the opportunity to buy 100 shares of stock in the future, and they all have expiration dates on them. You can't simply buy an options contract and then hold it indefinitely. It will expire at some point, and if you don't do something with the contract, it simply goes away, and the money that you spent buying the contract essentially goes away as well. So to make this more clear, one option, one call option, one contract is the right to buy 100 shares of a stock. Again, it's the right but not the obligation to buy those shares of stock. And the expiration date is simply the time frame for when you can choose to sell or exercise your call option. And exercise your call option simply means you're going to buy 100 shares of a stock for whatever price is on the contract. And again, if not sold or exercised by the expiration date, it expires and is essentially worthless at that point. So the money that you put into buying the contract will simply go away, and you will have nothing at the end of the day unless, again, you've sold off that contract or you exercise the contract and bought the number of shares on how many contracts you had. If you have one contract, you would buy 100 shares of a particular stock. So again, just to make sure this is all very clear, a call option is an agreement, it's a contract that gives the investor the right, but again, not the obligation. You don't have to do this if you do not want to in the future, to buy a stock at a specified price within a specific time period. So one price of a stock, and then the contract will, at some point in the future, basically expire if you don't sell off the contract or exercise the contract within that time frame. So why would you go ahead and jump into buying a call option? Well, you're assuming that the price for a call option, again, there are a number of different ways in which to trade options. You can buy a call, you can sell a call, you can buy a put, you can sell a put, or you can exercise an option. Today we're talking about buying a call. You're assuming that the price of the stock will go up. So the more the underlying stock price increases, the more the options contract for that price increases as well for that stock. So if you have a stock that's trading at a particular price, you have a specified price on the contract, and the stock is getting closer to that price or exceeding that price, the price for the contract is also much more valuable as well, and you can go ahead and sell off the contract without ever buying any of the stock on the contract. Why would I buy a call? Well, buying an option to purchase a stock is not buying the stock itself. Very, very important when you think about this. You're able to pay less money with the opportunity for higher returns at the end of the day. So you can think about this as buying, let's say, 100 shares of a $100 stock. You'd basically have to pay $10,000 for that opportunity. But on the other hand, maybe for an options contract, it's only $50. So you can have a contract again, to buy 100 shares of a stock in the future, but you don't have to go ahead and put down the enormous amount of capital that you would have to by buying the stock itself. You simply buy the contract to buy the stock at a future date, but you don't ever have to exercise that option. And as the stock price gets closer to whatever price is on that contract, the value of the contract goes up, and you can simply sell off the contract and make quite a bit of money, as we'll kind of go through an example with Ford here later in the video. How do I make money? Well, after buying the contract, after buying the option, you can sell the option and sell for a profit. So you can buy it and sell it like you would an individual stock or security, or you can wait until the expiration date to exercise it. You can buy 100 shares at the specified price on the contract, and you're hoping that the price of the stock is now above that price, so you can sell it at, or you can buy it at a lower price and then go ahead and sell it off whatever the price is, and that difference is the profit that you'll make by exercising that option. But much more likely way of trading this is simply selling off the contract before it reaches its expiration date. So what is the risk for options trading? The option will trade like a stock. Like I said, the value will go up and down with the value of the underlying stock, and then you will never lose more money than the price you paid for the call option. So you can go ahead and sell that call option off in the future for a profit, or you can wait until you can exercise that stock. You can exercise the stock at any point along holding that particular contract. We'll talk about that in a later video. It gets a little bit more complex, but you can go ahead and exercise the option or sell it off, but you'll never lose more money than what you paid for the options contract to begin with. So let's kind of take a look at some examples of this. First, focusing on what all these different terms mean. So the strike price, this is the price on the contract. This is the fixed price that you'll pay per share if you choose to exercise your option and buy 100 shares of a stock. Again, every option is 100 shares of a stock. You can see here, I have an example of Ford here, and we'll kind of go through the Robinhood application to show you this on the application as well. You can see here a call option for Ford. So you're assuming the price of the stock will go up in the future. The current price of the stock is $10.88, but in the future you think it's going to go up to $12. So you can go ahead and buy a contract saying, in the future I'd like to buy this stock for $12, and you're hoping that the stock, at the point the contract expires, the stock is trading at $13, $14, $15. So you can make $1, $2, or $3 per each individual share that you buy. And you can see on the bottom there, for the opportunity to do this contract currently, with an expiration date of May 4th, 2017, you have to pay 5 cents per share. Again, each contract, each option is 100 shares, so it's $5 to buy that option. So you can think about the price here. If the price of Ford goes up to $13, that's potentially $100 profit. $1 per share times 100 shares minus the $5 that you had to pay for the option. That's a $95 trade. You can see how exponentially greater the returns are. If, let's say, the price of the stock was $14 or $15, you'd make quite a bit of money on this options contract. So this is the power behind trading options. How is the price of the option kind of configured or figured out? Well, it's all about risk and reward. So if you take a current price of Ford at $10.88, I think it's going to go up to $12. That's quite a big range to kind of go over there for the stock to trend up. So the larger the spread between the current price and the price that is specified on the contract, the strike price, the lower price for each individual share of the call. So the lower the spread, the larger the spread, the lower the price of the call, because there's more risk. It's much less likely that the stock price will exceed that strike price. So where there's more risk, it's going to be a lower price for the particular option. Again, it's 5 cents per share on Ford here, but there's 100 shares, so it'll cost you $5 for each option that you buy. On the other hand, let's say the current price is $10.88. You simply think it's going to go up to $11. That's only 12 cents. So with this particular trade, it's a much smaller spread, and it's a much higher likelihood that the stock price will exceed that strike price. So smaller spread, higher price call, so each individual share is going to cost more because there's less risk. Less risk, higher price, more risk, lower price when buying these options. And if the price of the stock does go above your strike price, so let's say that Ford stock trading at $10.88 goes up to $13, the contract price, the strike price is $12, now you're in the money. You can exercise that option at any point, or you can sell off that contract, and you can go ahead and buy Ford, for example, if you exercise the option at $12, then immediately sell it off on the market at $13, and you make $1 per share. So for that $5 initial investment, you'll make $100 minus the option fee. You made $95 on that trade with investing very little capital. That same trade with buying the price of Ford, you'd have to buy $10.88 times 100. So over $1,000, and you simply spent $5. So you can see why using options is much more beneficial, especially for investors with lower amounts of capital. You can simply put $5 into a trade and make $95, whereas if you bought the price of the stock at the market price, $10.88 to begin with, you have to put literally thousands of dollars into the stock to make that same trade, the same value of that trade. So that is the power behind trading in options. And again, for the expiration date, the more time between when you establish a contract and when it expires, it's more expensive because there's a much higher likelihood that the stock will have time to trend up above the strike price. If there's less time on the contract, it's going to be less expensive because there's a higher risk that the stock will not get above that strike price. So again, it's all about risk and the price of the stock. So the more risk, the more likelihood that the contract will trade cheaply, and the lower the risk in the trade, the more likely that the contract will trade higher in price. So more risk is a less price of the options contract. Less risk is a more highly priced options contract. So just kind of an inverse there. So again, kind of put this into the video as well. More likely to reach the strike price equals less risk, so it's more expensive. Less likely to reach the strike price equals more risk, so it's less expensive. So this is, again, one of the easiest ways of trading options on the stock market. Buying a call option, you're simply betting on the fact that the price of the stock will move up above your strike price. So the price of the stock will increase higher than what is on the contract price. So let's now jump into the application here to show you guys how this looks on the application here. If we click on trade in the bottom right hand corner, we can click on options. You can see here that there is a nice little screen here going through exactly what the whole idea behind options trading is. Again, we're going to be buying a call here. So you can see on the top there, you can buy a call, you can buy a put, you can sell a call, you can sell a put. We're going to go ahead and do a buy order for a call. And again, let's kind of go through the example that we showed on the video here. Let's scroll over to May 4th. This is the expiration date of the contract. If we go up to a call of $12, you can see that in the middle there, 5 cents per share. Again, it's 100 shares for every option, so it'll cost, let's say we do one option here, it'll be $5. Simply 5 cents times 100 shares, $5 to buy that particular contract. Again, that is specifying by May 4th, we can buy Ford for $12 per share. Right now, that would not make sense because the share price, as you can see on the bottom there, is trading at $10.88. But if the price of the stock were to get up to $12.05, as you can see the break-even point there, the price of the stock plus the price we paid for the options contract, if we bought at $12.05, we could sell off for $12.05 and essentially make even money. But if the price of the stock is above $12, we'll make that difference. Or as time elapses, that 5 cents may go up to 8 cents, 9 cents, because it's much more likely that the price of the stock will go above that strike price of $12. Then you can go ahead and sell off the options contract. Again, maybe making 3 cents for every share, so $3 per options contract, and you only bought it for $5. So you can sell it off for $8, bought it for $5, $3. So you can see as you put more money into these contracts, you scale up the enormous potential for profit that can be made with just a little bit of capital put into a contract. And again, let's kind of go through to show you guys how the prices will change. So as we go further out, it's going to be less risky, and you'll see that the price of the contract increases now to 8 cents. June 15th here, there's not a $12 strike price. There is not one for September 21st either. For January 18th, you can see now it's 47 cents because it's much more likely that the price of the stock will be above $12 at that point. January 17th, you can see it's now up to 89 cents per contract. So the more time in the contract, the higher the price, and vice versa. Let's go back to May 4th, our contract date. Now let's say we want to do one that has less time in it. So it's currently at 5 cents per trade. For less time, that $12 call will be 4 cents. So less for each individual share. Now it's 3 cents, April 13th, 2 cents, April 6th here, 1 cent per share. So as the time decreases, the price goes down. As the time increases, the price goes up. Again, all about risk. Much more likely over a long period of time that your call price, your strike price will be met. As well, if we go up here, $12.05, it's much less likely that it'll hit that. Let's go over to some of the pricier stocks here. Let's do January 18, 2019 here. So you can see that $12 strike call is 47 cents on January 18, 2019. And as that price of the strike goes up, you can see the price of the contract goes down as well, because it's much less likely, there's more risk for you as an individual investor that the price of the stock will not get over that particular price. That $21.87, virtually impossible that Ford is going to be trading above that on January 18, 2019. And you can see that reflected in the price of the contract. It's only 2 cents. As we go down less in price here, you can see some of these are very, very pricey just because you can buy Ford at $4.87 per share. But again, you have to buy it for $6 per share. So if you add those two together, it's $10.87, and the price is $10.88. So you can see that the price of the contract as well as the strike call really is trading at about what the share price is for the price of the stock under the current share price, or even very close to the share price. But as you get farther away from that, much higher than what the current stock is trading for, the price of the contract decreases dramatically. So just kind of going through the application here, showing you guys exactly what we demonstrated in the video. More time, less risk, higher contract price, less time, more risk, less of the contract price. And as the strike price increases, the price of the contract also decreases as well. So I hope this made sense, everybody. Again, I wanted to do a very concise video here, really focusing just on the call option and really what options are all about. Again, there are contracts to buy a stock at a specific price in the future, but you don't have to necessarily exercise that option. You're not obligated to buy the stock at that price. It's simply a contract. You can either sell that off or exercise it, and if you don't do either of those two things, the contract simply expires, and the money that you put into buying the contract simply vanishes as well. So a very cool way of trading on the stock market, a way of trading, really enhancing the amount of capital that you have. It takes less capital to do these trades. They're higher risk trades because you really don't have anything at the end of the day. You either have to sell off that contract or exercise the contract. It's not like a stock where you can buy it and hold it for a number of years waiting for that price to trend back up. The contract has a defined expiration date, so you need to either sell the stock, or sell the contract by that date, or buy the stock whatever the specified price is on the contract. So that is how call options work. Again, wanted to do a very quick and easy video trying to understand exactly what call options are all about. If you have any questions about anything I said in the video, please let me know in the comment threads down below. Again, I'll be doing a multi-part series talking about all of the different ways in which you trade options. Again, much more complex than simply buying and selling an individual security. So I hope you guys kind of followed along that video. If not, again, let me know in the video and I'll do an updated video if there are enough inquiries or questions about any particular part of trading an options call here. Again, trading, one of the easiest understood ways of trading options, a call option. So kind of with that, not to make the video too long, I'll kind of end it here. Again, if you guys have any questions about that, please let me know in the comment threads down below. And I'll try to do my best to get back to you guys as quickly as I can. And again, if you guys enjoy the videos, if you enjoy the content on the channel, feel free to like, share, and subscribe. And kind of with that, I'll end the video, and we'll see you guys next time.